The White House sought to tamp down concerns from the American public with Wednesday's report that inflation jumped at its fastest pace in nearly 40 years last month, a 7% spike from a year earlier that is increasing household expenses and also eating into wage gains. The Labor Department reported on Wednesday that core inflation, which exclude volatile food and gas prices, also jumped 5.5% in the month of December, rising to the highest level in decades. Meanwhile, the consumer price index rose by 7% in December, the fastest pace in nearly 40 years. Previously on Tuesday, the Fed's chairman, Jerome Powell, acknowledged that high inflation has emerged as a serious threat to the Federal Reserve's goal of helping put more Americans back to work, and that the Fed will raise rates more than it now plans if needed to stem surging prices. Following the Fed's comments on Tuesday, many markets surged, including those in Asia, as investors were eased by Powell's statements that the U.S. economy was still far away from a normal situation.
The economy is expanding at its fastest pace in many years, and the labor market is again strong. As always, challenges remain. Both the individual shutdown and the subsequent reopening of the economy were without precedent. The economy has rapidly gained strength despite the ongoing pandemic, giving rise to persistent supply and demand imbalances and bottlenecks, and to elevated inflation. We know that high inflation exacts a toll, particularly for those less able to meet the higher costs of essentials like food, housing, and transportation. We are strongly committed to achieving our statutory goals of maximum employment and price stability. We will use our tools to support the economy and a strong labor market and to prevent higher inflation from becoming entrenched. Now we're stimulating demand with very highly accommodative policy. As we move through this year, we will, in all likelihood, we don't know the future, but if things develop as expected, we'll be normalizing policy, meaning we're going to end our asset purchases in March, meaning we'll be raising rates over the course of the year.
And now to talk more about the U.S. record high inflation, how that impacts Indonesia in particular, and also to help unpack and also explain the latest comments by the Fed chairman, we are now joined by the chief economist from Permata Bank, Josua Pardede. Hi, Joshua.
Hi, Makanya.
Hi, it's a pleasure to have you on the show. So first, let's talk about these latest comments by the Fed's chairman, Jerome Powell. After his comments, we saw many markets, such as those in Asia and also in U.S., surge. So tell us why investors should be less worried following Jerome Powell's latest statements.
Yeah, I think I can say that there are two things that can be interpreted by U.S. inflation data, which just released, and also the recent comment from Jerome Powell. Mr. Powell mentions that inflation in U.S. is relatively high, and also after the Fed just implemented the extraordinary accommodative policy since the beginning of pandemic COVID-19. Yeah. So basically, when we saw that the inflation U.S. increased significantly to 7%, which is the highest since 1982. So it can be interpreted that actually it will impact negatively to the economic growth. Yeah. Okay. Because inflationary pressure will lead to the lower purchasing power, and also if the investor invests to a country with high inflationary pressure, I think the real yield becomes more or less becomes decreasing. So that's the first thing. And the second one, we can interpret that in the market, it is known as profit taking, or if you buy on rumor and you sell on fact. Yeah, basically when Jerome Powell mentioned that the inflation already hit 7% and the probability of the Fed rate hike continue to increase, basically the clarity on the timing of the Fed rate hike, I think becomes lesser, and also I think becomes easing, and then after the clarity, market becomes more clear about the timing and the magnitude of Fed rate hike, I think it is common and it is well known as the profit-taking action from the market.
Okay. We also, as I mentioned, the Fed's chairman, following Jerome Powell's latest statement, caused many markets to surge, and we want to see what's happening in the Indonesian market as well. It just bounced back, snapped back after 3 days of losses. So where is the direction of the market moving forward?
Yeah, actually, if you look at the dollar index, which is the US dollar performance against major currencies, already dollar index have weakened around 1.6% compared to end of last week, yeah, and also rupiah has managed to appreciate in this week compared to last week. And then if you look at the Indonesia Stock Exchange, also seem to be appreciating, yeah, for some sectors or some stocks, where we also seen that today's performance. Some stocks related to the technology stocks, I think, has dropped around 3%. Yeah. So basically, I think we can see the direction in the short term. Yeah, for a condition like this, because this is for some people, I think this is very rare. Yeah, or to be something strange. Yeah, because when the inflation increase and the probability of rate hike continue to increase, why the dollar continue to weaken. Right. So I think we still believe that the rupiah and also other emerging countries could be affected negatively by the Fed's plan. Okay. Regarding to normalization its monetary policy going forward. Yeah, although we note that the capital flight race compared to 2013 taper tantrum, I think is relatively lower, yeah, because most emerging countries, including Indonesia, actually, if you look at the fundamental factors, I think tended to be much better compared to 2013. So I still believe that rupiah still could manage to be around its fundamental level, meaning that around 14,300 to 40,600, and then GCI, I think, or IDX still around 6,600 until 6,700, yeah, in the short term, yeah. But we still need to anticipate the going forward, yeah. If there is another surprise from the Fed, yeah. This could be another risk also for emerging countries. Not to mention also the impact of Omicron variant to global economy.
Okay. Well, so what are the different scenarios? As we saw, inflation is still very high in the U.S. But when do you think the Fed will start increasing interest rates to help stem inflation? What are the scenarios that you have envisioned going forward?
Yes. Again, I think the central bank doesn't like high inflationary pressure. Yeah. So I think as soon as the tapering process ends in March 2022, I think there is a probability, a higher probability that the Fed will start to increase interest rate in March meeting. Yeah, that's the soonest time where when the Fed could raise interest rate. Yeah, because yeah, we know, although on the one hand, yeah, inflationary pressure could be easing, yeah, when the supply chain bottlenecking continue to normalize. But I think Jerome Powell and his colleagues at the Fed, I think doesn't like the inflationary pressure. So I think as soon as the tapering process ends, I think there is a chance of Fed rate hike in March. And I think if you look at from the December meeting, the current probability is 75 basis point, but it could be higher than 75 basis point if the inflationary pressure still persists until first half of this year.
Okay. And what kind of an impact will it have on the Indonesian market, do you think, if that happens?
Yes. Again, yes. When the Fed raise interest rates or higher than earlier expectation or give some hawkish statements regarding to the Fed interest rate hike this year. I think this could probably impact, again to emerging market assets, because normally and theoretically, when when advanced countries, including U.S., started to raise interest rate, I think there is there will be some potential of from capital flight from emerging markets. So basically, it will impact to rupiah, to Indonesian government bond yield, and also other emerging market bond yield, and also emerging stocks. But the impact, I think, will be limited. Taking into account that again, basically the fundamental factors, and also the communication that has been built by the Fed officials currently is relatively much better compared to the Fed's communication during 2013 back that time.
Okay, so that's so let's talk about the fundamentals, the Indonesian economy fundamentals. What's your outlook? Do you still believe that Indonesia's economic fundamentals are strong enough to withstand external pressures in this year, in 2022?
Yes, I still believe that it is indicated by latest World Bank reports, regarding to its forecast 2022 GDP growth. For some countries like U.S., China, their GDP growth forecasts have been revised down by World Bank, including U.S. and also China. But for Indonesia case, I think World Bank revised up the GDP growth, to around 5.2% this year. This means that the basic meaning that the economy of Indonesia is strongly driven by domestic demand, and also investments. So basically, by these two components, consumption and also investment, I think this will support the GDP and also the economy. And from the external condition perspective also, as we can see that the current account balance, Indonesia current account balance seem to be surplus in 2021, and it could be continue in 2022, taking into account that the current uptrend in commodity prices will support Indonesia's export performance. And this also, basically, these two fundamentals, or these two figures, I think will reflect that the fundamental of Indonesian economy is much stronger compared to 2013 condition.
Okay, so you're still very optimistic about this year, Chief Economist of Bank Permata, Josua Pardede, thank you so much for joining us on this show. And up next, we'll have the